You're welcome once again to um, another module of the Binary Options Trading Challenge (BOU), organized by BOU and the Binary Options University. I hope the introduction was impactful, and I hope you're expectant. Everyone is expectant of much more educative and impactful um, teaching. Okay, so today, yesterday or the other time, Module 1, we talked about introductions to binary options trading. And today, we are going to go a step further to talk about we're going to go a step further to talk about the trading terminologies. Okay, so the trading terminologies, these are very, very important language. It's a language, trading language that must be mastered. You can imagine how it will be for a doctor not to know medical terminologies. You can imagine how it will be. It will be a disaster for a medical doctor to work in a team or to perform a surgical operation on a patient without using medical terminologies. So terminologies are slangs, words that um, traders are conversant with. They are words that create a fun environment, and they are also words that help people convey a message that is targeted at a particular niche or targeted at a particular audience who share common values or common aspirations. Okay, so basically, trading terminologies. There are so many trading terminologies, but we are going to um, touch on the major terminologies used in binary options trading. And so I'm sure that at the end of this session, at the end of this module, you would have known the basic and the most important terminologies used in binary options trading. Okay, so the first terminology that we will talk about today is fundamental analysis. Okay, I know a lot of you must have heard about this terminology from the news, social media, or from your colleagues, or from your friends, your parents, from the newspaper. Fundamental analysis. Basically, it's macroeconomics. Okay, and so we know macroeconomics. Anyone that is, you don't need to be a professor in economics to know. You have a clue as to the meaning of this word. Macro means big, large. Okay, so macroeconomics controls the entire financial market, be it stocks, currencies, or commodities. They influence the market reaction. Okay, fundamental analysis is primarily a technique for creating a market bias by breaking down complex data such as earnings reports, retail sales, employment, unemployment rates, etc. Fundamental analysis facilitates a trading opinion about the overall health of an asset. Okay, so basically fundamental analysis gives us a clue as to the directional bias of an asset. The fundamental analysis is what gives, I would like to call it the food. It's the food. It's what feeds the market. And the market needs the fundamental to move. The market thrives on fundamental analysis. Fundamental analysis is basically how the market receives the news first before reacting. Okay, so the fundamental drives the market, while the technical, which I will describe later on, is a reaction to a fundamental release. Okay, so be it a news, employment data, retail sales, earnings reports, crude oil inventories, and so on. Okay, so the fundamental analysis is like the live wire of a market. Okay, so fundamental analysis is just like the breaking news. Okay, so you receive the breaking news, and you act. Before acting on the breaking news, that is fundamental. Okay, so fundamental analysis is the way people receive the news. Okay, so fundamental analysis is a type of analysis that interprets or makes use, utilizes. It's a kind of analysis whereby traders pick on fundamental data and then interpret this data for a trading decision. Okay, so we have series of fundamental data that can be used for analysis. Okay, so fundamental traders basically they thrive on news. They are only waiting for a news release and then for them to interpret or the PE ratio and the earnings per share. There are so many of those data that people wait for. So fundamental analysts or fundamental traders are those that wait for a fundamental data. They are those that interpret, analyze fundamental data for trading information or for trading decision. Okay, so basically fundamental analysis facilitates a trading opinion about the overall health of an asset. Okay, so as a rule of thumb, we advise technical traders to trade. You can't just focus on the technical. You can't just trade using technical analysis without understanding the overall sentiments of the market. You must know the overall bias in the market. You must know what is driving the market. Okay, so if you don't know what is driving the economy, you cannot trade the economy. Okay, you must know what is driving. It's just like a driver driving a bus. So without a driver, the bus, although the bus has an engine, the bus cannot move. Okay, so the bus still needs a driver to drive the bus to its destination. Okay, so the bus requires a driver. Okay, so the driver is the fundamental data. Okay, why technical analysts might want to argue that fundamental analysis is not required, but we as an institution we will encourage and we advise people, we advise all of our students to use the fundamental data as a guide. Okay, so as we go on, we'll further expatiate this. We advise our students to trade with the fundamental data in mind. Trading with the fundamental data in mind gives you an edge over those who would only trade with technical analysis. Okay, so and the recommended websites for fundamental analysis include barter.com, investing.com, and forexfactory.com. Okay, so basically these are the validated sources of fundamental data. Okay, so the barter.com is very, very trusted, and they post reliable data every day. Investing.com is another website that is used by millions of traders all over the world. Okay, forexfactory.com is a go-to website for um, currencies, any news pertaining to currencies, and basically for forex traders. Okay, so those who trade binary options. Okay, so but you really need to know the news release and the time when this news will be released. Okay, so you need to go to Forex Factory on a daily basis, to have inside information as to the release time and the kind of data that will be released. Okay, so as we go on, you will understand better. Okay, so let's proceed. Technical analysis. Yeah, technical analysis. So the name as explained it all. Technical analysis, as the name depicts, it's a more technical approach to trading. Technical analysis is not just the interpretation of data or the application of data to arrive at a trading sentiment or decision. Technical analysis is the use of is the quantitative application of technical indicators for forecasting the direction and price action of an asset. So the technical analysis is the use of indicators, and so these indicators they are like a navigation guide. Let me use that word. They are a guide. They are like the road signs, and they are like the maps. The road sign, the signages on the roads, and they actually give you a clue as to where the market is headed. So they give you a clue as to where the market is going to. The technical indicators will give you early signal about a potential reversal. A technical indicator, we can also tell you when momentum is shifting from bullish to bearish. A technical indicator can also inform you about the trending condition or the ranging condition of a market. Okay, so the technical indicator can do so many things. So there are so many indicators that can be used to trade binary options. In fact, we have so many strategies around. Okay, so but we advise that you master 2 to 3, 4 indicators. Having an overload of indicators will only affect you, and it will affect your trading analysis. Okay, so the most valuable indicators for binary options trading include candlesticks, support and resistance lines, relative strength index, and Bollinger Bands. So basically, we consider these indicators um, the most valuable for binary options trading based on our years of intensive and extensive research and testing validation protocols. Okay, so candlesticks, having a candlestick chart is not negotiable. The resistance line, as we proceed, you will understand why we consider these lines as very, very, very pivotal to the success of any binary options trader. Okay, the relative strength index gives you an indication as to the momentum of the market. So it tells you, it reveals whether the market is oversold or overbought. Okay, and the Bollinger Band, it's a two-in-one indicator. As we go on, you would realize that this Bollinger Band is sent from heaven, because it is a two-in-one kind of indicator, having a moving average and also having the bands. Okay, so it's amazing. So let's proceed and learn some deeper truths. Trading hours. So trading hours. Okay, so you cannot, it's just like every business opens at a certain time and it closes at a certain time. It's impossible for a business to run without a plan. Okay, so these hours are the periods when the market, people are buying and selling assets for that day. Okay, so we have various sessions. We have the New York Stock Exchange, we have the Tokyo Stock Exchange, we have the London Stock Exchange. These are the major exchanges that influence or control the activity of assets on a daily basis. Okay, so and in binary options trading, it is in your best interest to trade within these time zones, because this is when people are buying and selling. Okay, so trading outside these zones will reduce the efficacy or the accuracy of your strategy, as those periods will lack the required volatility and volume to move a trade in your direction or in your perceived direction. Okay, what I mean is this: trading outside these time zones will mean that the trades will move slowly, and then also volatility cannot be predicted. So it's very unpredictable, to trade with outside these time zones. So we advise all our students to trade within these time zones, as you are in a better control. You are in a better control over the movement and direction. Okay, so the New York Stock Exchange opens at 13:30 GMT and closes at 20 GMT. The Tokyo Stock Exchange opens at 0:00 GMT and closes at 6 GMT. The London Stock Exchange opens at 7 GMT and closes at 15:30 GMT. And so I would like you guys to take note of these time zones and ensure that you trade within these time zones. Okay? Yeah, so an increase in market activity, volatility, and volume is observed when two of these major trading sessions overlap. Okay, so when there's an overlap between two of these, either New York or Tokyo and London, if two or when two exchanges overlap, those periods are the periods when the market is most volatile, and there are times when the market has a very good volume, a large influx of traders buying or selling. Okay, so let's move on to the next one. A broker. The essence of this is to become more familiar with these words, this terminology, so that you can actually be more confident when speaking to people about what you do. You cannot be trading or investing in binary options and not know the most important terminologies. So binary options brokers act as an intermediary between an investor and the securities exchange. They provide a platform whereby individual investors can buy or sell an asset. Brokers registered under Cyprus Securities and Exchange Commission (CSEC) are considered safe and regulated. Okay, so we always advise our students to ensure and to confirm the registration of their proposed broker. Always ensure that they go to the site of the broker and carry out extensive and also intensive research on such broker before investing or depositing any amount of money. Okay, so you have to ensure that they are registered under CSEC. CSEC is Cyprus Securities and Exchange Commission. And so that is the regulatory authority in charge of regulating the activities of binary option brokers. Okay, so this is the first step in deciding on the broker to use. Okay, so always ensure that the broker is registered under CSEC, and there are a list of them. IQ option is one of them. Okay, there are many more that are registered under CSEC. Okay, so do your thorough investigation, research before depositing your money. Okay, the market order. A market order in binary options is called call put options. A call means buying an asset, stocks, currency, or commodity at the current market price, while the put means to sell an asset at the current market price. Okay, so the market order is when you place a trade. You're either buying or you're either selling. Okay, so you're buying when you envisage the asset going up, and you're selling when you feel the asset will drop in value. Okay, so each of these orders are accompanied by a time expiration time. Okay, so once you place a market order, you are placing the order for a particular asset to move in a particular direction within a particular time expiration time. Okay, so the time frame, this is the specified period in which an asset is expected to change direction. Candlesticks are used to organize the activity of an asset into time frames. In binary options, 1 minute, 5 minute, and 15 minutes candlesticks indicate a short-term approach, while 30 minutes and 1 hour are longer time frames. Okay, so as I mentioned earlier, you can't trade without the candlestick chart on. Okay, so the candlestick chart organizes the activity of an asset into time frames. Okay, so the 1 minute candle, it means that the market opens and closes within 1 minute. So one candlestick represents 1 minute in the 1 minute chart. In the 5 minute chart, the candle opens and closes within 5 minutes. So the 5 minutes candlestick chart is represented by 5 minute candles, and they are candles that open and close within 5 minutes. The 15 minutes candlesticks, they are candles that open and close within 15 minutes. So one candle is 15 minutes on the 15 minutes candlestick chart. Okay, so and 1 minute, 5 minutes, and 15 minutes indicate a short-term approach, while 30 minutes and 1 hour are longer time frames. What that means is that if you're using a 1 minute candlestick, your expiration time should be 1 minute. If you're using a 5 minute candlestick or 5 minute candlestick chart, your expiration time should be 5 minutes. After evaluating your strategy and determining the direction or directional bias, your expiration time should be within 5 minutes. 5 minutes exactly. If you are using a 15 minutes candlestick chart, your expiration time should be 15 minutes. If you're using a 30 minutes candlestick chart, your expiration time should be 30 minutes. If you're using a 1 hour candlestick chart, your expiration time should be 1 hour. The bears and the bulls. The bears and bulls reveal the momentum and direction of the market at a specific period of time. Bears signal a strong downward momentum, while bulls indicate a strong upside move. The market is constantly changing, with the bears and bulls constantly fighting for supremacy. Okay, so basically the market is never is never stationed at a particular direction. The market is never going in one direction. No matter how good an asset is, people can never continue buying that asset. It will get to a point whereby people will feel that that asset is overpriced and expensive, and so that asset will begin to fall. So the price of an asset can never continue rising. And so you have the bears and the bulls. These are the two actors in of the movie. They are the two actors, because the bulls are pushing it up, the bears are pushing price down. Okay, so the bulls are up, the bears are down. Okay, the bulls are up, the bears are down. So if when you trade in the direction of the bulls, you become a bull. Meaning, when you place a trade in the direction of the trend, uptrend, you are a bull. When you trade in the direction of the downtrend, you are a bear. Okay, so you are either a bear or a bull. Okay, so the bears push price down, the bulls push price up. Okay, and so these are the two actors, the major actors in this movie. Okay, and so the bears signal a strong downward momentum, while bulls indicate a strong upside move. And so the market is constantly changing, with the bears and the bulls constantly fighting for supremacy. So this is a classical representation of the bears and the bulls in action. So you can see from the candlestick chart that at this point the bears are in control. The bears are in control. Look at how strong the downside, the down move is. You see it in a downtrend. The bears are constantly pushing it. Look at, there was one bull here. This green bull tried to push the price back, but the bears were too many. The bears outnumbered the bull, and so the bull failed in an attempt to reverse the trend because the bears outnumbered the bull. Okay, so you can see there were many bears and one bull in the territory of the bears. So it's impossible for one bull to defeat bears in their colony or in their natural habitat. Okay, so, and look at this too. Look at the bulls. The bulls are in control here. The bulls are going up and they're pushing the price up. And so you can see there was a particular bear that tried to bring the price down, but the bear was outnumbered by the bulls. The bulls are in charge. Okay? A trending market. This is the overall direction of an asset within a period of time. A trending market is one that moves in a given direction with a relative increase or decrease in strength, either up or down. Okay? So a bullish market has a very strong upward momentum, while a bearish market moves in the opposite direction. That's down. Okay? So like as we mentioned earlier, the bulls are constantly pushing the price up. The bears are pushing the price down. Okay, so a trending market is one that has one player dominating the other one. A trending market is one with either the bull or the bear in full control. Okay, so in an upward trend, the bulls are in full control. In a downward trend, the bears are in full control. So you have the bearish market and the bullish market. Okay, so these two markets can be considered as a trending market. Okay, so we have the ranging market. A ranging market is one that moves sideways without making a higher high or a lower low. It indicates low market activity. The market usually oscillates between a trend and a range. Okay, so after long periods of trending, a market will usually consolidate. It will usually retrace and then form a ranging market. A ranging market is a form of relaxation. The market is relaxing. The market is going through a period of consolidation. It's going through a period of determining what next or what action to take next. Okay, so the market is actually deciding whether to continue in the trend or reverse to begin a new trend. Okay, so a ranging market is a sign that something is about to happen. Okay, it is one that moves sideways without making a higher high or a lower low. It indicates low market activity, meaning the market is not going up or it's not going down. So it is ranging between two areas, two support or resistance areas. It is ranging between two areas and oscillating between these two areas. Okay, and so the ranging market, an asset will never be a trend forever. It will move from being a trend to being a ranging market and back to being a trending market. Okay, so the market is first trending, then ranging, then trending, then ranging. Okay, so these are the two kind of markets we have in every asset. Okay, so this is a classical example of a trend. Okay, so you can see the market is making a higher high. Okay, this is the previous high, and then a retracement, and the market goes up again to make a higher high here. And so this is a classical uptrend, indicating the strong activity of the bulls. The bulls are in full control here. So this is a classical bullish trend, which is also an uptrend. So this is a trending market, a classical trending market. The market is making a consistent increase. And you look at the increase in momentum. This was the previous high, then this is a new high, and this is a new high. So the market is making a higher high. The first, the second, this is higher than this, and this is higher than this. So the higher high, okay? The ranging market. In a ranging market, the market is fluctuating between two levels. And so this is one level, and this is another level. You can see the market is fluctuating, it's not moving out of the Bollinger Band. As we proceed, you will understand more. And then when we discuss the indicators, you will now understand, and you understand the full potential of the Bollinger Band. So this is the Bollinger Band. 1, 2, 3. This is the Bollinger Band. And so you can see the market is forming inside the Bollinger Band, not breaking out of the band. So whenever you see a market forming inside the Bollinger Band, that market is a ranging market, because it's failing to make a higher high or a lower low. So it's forming within an established level. So it's not breaking out of the Bollinger Band, but it's just forming within the band. So this is a classical example of a ranging market. Okay, so the bulls are not in control, the bears are not in control. It is a constant swinging pattern. So you can see here, you see the bulls are in control, then the bears are in control, the bulls are in control, the bears are in control. So there's no powerful dominating force in the market. So the market is switching and oscillating between. So the market is not in one direction. It's not moving up or down. It's moving sideways. You can see this is sideways. It's moving sideways. It's not making a higher high or lower low. So it's a sideways movement. Okay. So when you see a sideways movement, that is a ranging market. Okay, so the next one we're going to talk about is the expiration time. The expiration time. This is the duration of a buy or sell binary options contract. A binary options trader is required to select an expiration time from 1 minute to end of the month before entering the trade. Okay, so you have the luxury of selecting from a diverse range of expiration times. Okay, so we have 1 minute expiration, 5 minutes expiration, 15 minutes, 30 minutes, 1 hour, end of day, end of the week, end of the month. Okay, so based on your trading strategy, you can decide on which of the time frames or the expiration time to settle for. Okay, so we have a range of expiration time. So it's amazing. So the risk averse people, traders, the risk averse traders would opt for the longer time frames, while those that are more risk tolerance we opt for the lower time frames. Okay, so the volatility. This is the measure of the rate of change of an asset price. Okay. High volatility is indicative of an underlying high impact news. Okay, is indicative of an high impact news release such as earnings, CPI, inflation rate, crude oil inventories, etc. The Bollinger Band is a very reliable indicator for gauging the volatility of the market. In binary options, assets with extremely high or low volatility should be avoided. Okay, so the volatility is basically the rate of change of an asset price. So when a market is tend to be volatile, to be extremely volatile, when it moves suddenly from a particular position to a very very wide position. What I mean by that is that when it moves suddenly, it forms a trend suddenly. When you're seeing one candlestick form a trend, move from a low point to a very high point. Okay, so the movement is sudden, is rapid, is of a higher proportion. Okay, so when you see a candlestick moving in an abnormal fashion, that market is very volatile. So we advise our students to always avoid markets that are very volatile. So high volatility will ultimately reduce the accuracy of your strategies, because there are times when the market is most unpredictable. Okay, so never trade high volatility assets. Okay, always trade assets that have normal volatility, as seen on the candlesticks. You will see it whenever a market is volatile. You will actually see it. The candlesticks will reveal the volatility of an asset. When a candle is very very bullish, the close and the open and the close is very wide apart. You can know that market is very volatile, and so it's best to avoid markets or assets or instruments that are very volatile, extremely volatile. Always avoid volatile markets. Do not trade. Do not trade. Do not trade assets that are highly volatile. Never, never trade volatile stocks, currency, or whatever. Okay? So this is an example of high volatility in display. You can see it. The volatility is extremely bullish. Look at where the price started from. You can see the open and the close is very wide apart. So this is an example of high volatility probably caused by a news release or high impact fundamental data. Okay, so never, 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 never trade during these times. These are very unpredictable periods that traders lose money. Okay, so these are unpredictable periods that traders lose money. I repeat. Okay, so never, never, never trade during volatile periods. Okay, this is a period of very high volatility. Never trade a market that is displaying this kind of pattern. Okay, so this is a squeeze. This is a period of low volatility. So never trade a market that has very high volatility. Never trade an asset that has very low volatility. So you can see this is a period of low volatility. This is a period of low volatility. You can see it on the Bollinger Band. The band is too narrow. So when you see this kind of pattern where the Bollinger Band is forming, is really constricted. Look at it. The distance between the bands is very narrow. Now compare it to this. See how wide this is, wide apart. The two bands here are very wide apart. Now compare to this. The two bands are very narrow. So never trade this kind of market. Look at how narrow the market is. It's very, very low volatility. These are periods when you cannot have control over the outcome of your trade. Never, I repeat, never trade a volatile market. Okay, so basically we will be discussing in the next class. We'll be talking about indicators. We'll be talking about the indicators because the indicators are they are the pointers as to where the market is headed for. Okay, so in the next class, in the next module, we are going to be discussing indicators. Okay, so I believe that with these terminologies that you have learned now, you are well positioned to further understand the topics that we'll be discussing. You are well positioned to understand the strategies that we'll be talking about, because now you are more familiar with the trading terminologies. And so when I say the bull, you understand what I mean by that. When I say the bear, you understand what I mean by that. When I say volatile, you understand what I mean by that. When I say low volatility, you know what I mean by that. Okay, so when I say a broker, you know who a broker is. Okay, so you know a trending market, you know a ranging market. All right, okay, so you know all this. So basically these are the major terms that we use in trading the binary options. So thank you once again for joining in. See you in the next class. Thank you so much. Thank you. Bye.